I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Mike Swanson, editor of WallStreetWindow.com. Welcome back to the show, Mike.
Oh, it's great to talk with you. It's kind of funny, though, because we talked, I think it was just about 2 weeks ago, and the stock market's barely even moved since then.
Well, yes, they took a break because we weren't talking about them.
It sure seems that way. But that does, though, to people, is it really makes people fall asleep. And you feel like, oh, nothing's going on. And I was watching CNBC last night when the stock market closed, and they're getting all excited because Tesla reported earnings, and they said they're going to make this surprising profit. However, they're doing accounting gains to do that. They've changed the way they're doing their accounting to defer costs and change their receivables and do stuff like that. But it made for a really exciting headline, and the stock gapped up about 5% this morning, and it's given back most of those gains. So if it was a real turnaround, it would be blasting off to the moon, and it's not. And that's the point of that, is that's kind of what's going on in the stock market. There's nothing big with the market averages, but silly news every day that, people got to find something to talk about on TV, or, people that do like to trade the market, they want to trade something and find something that's moving in the morning. So that was the story today, was Tesla.
Well, people should know, in consumer confidence and trustworthiness, Toyota ranked number 1. Tesla was 25 out of 29. So you might be prepared to take it back to the shop a few times before you get the car you really want.
Yeah, I'm not. I actually saw one, a Tesla car last week. I was out of town somewhere and saw one. I have no interest in buying one. I've got a Toyota, to tell you the truth, and I'm just going to keep driving that, and I don't need to blow my money on some fad like that. I'm not going to do it. And I don't like to trade the fad stocks either, because they tend to move crazy, and, it's kind of like gambling, and especially a stock like that where they changed the accounting, and he's done strange things in the past. He did a merger with his Solar City company, which is just bleeding money, and if he didn't do the merger, it would probably end up going bankrupt. So I just don't trust that CEO or the stock or anything. But as far as the stock market goes, we spoke last week, or the other week, about Warren Buffett, and he was raising cash, or letting his cash reserves grow and not deploying it into the stock market. He had about $75 billion in cash, and I don't have that kind of cash money anywhere, but I am building cash reserves in my own brokerage accounts too. I'm not fully invested. I've got 30% in cash reserves because the market is highly valued right now, and I do think we are going to actually see a little bit of a drop before the year's over. And I like to buy stuff at cheaper prices, not higher prices.
Well, some people have predicted a drop not only of, say, 20%, but up to 70%, because the 4-year cycle is now out to 7 years and things are about to break.
Well, I don't think it's going to fall that quickly here, not in the next couple months. What I really think is happening is we're in a sort of a transition phase in which we'll end up having a bear market, but it could very well be that the very top of the market is in when it comes to the price of the market. And actually, ironically, in 2015, in July, I put out a long report, and I think we talked about it on your show, and I was saying the market had topped in terms of valuation from a certain, and probably in price. And the valuation, it does seem that part has happened for sure, and the prices have really gone nowhere since then. But this fall has been particularly unusual because the volume disappeared in the market in the summer. It usually does that. People go on vacation, they take breaks, and then the volume will come back after Labor Day. It didn't do that. The volume hasn't really picked up, and the market averages have barely made any moves at all. In August, 2160 was acting as a support level in the S&P 500. We talked about that as a key level to watch out for a break of that, and it did break. It broke in September. The market fell to 2120 in the S&P, but since then it's trading in a range of 2120 and really 2160, and now it's about in the middle of that range. But the longer it stays in it, the more likely it is to be broken. And like I said, I think it will probably be a break to the downside. And the reason why is the internals in the market are trending down. That means there's more stocks that have been dropping than going up. And typically when that happens, the cause of it is there are only a few big cap stocks still going up, still causing excitement, and then they top out, and then the averages go down. So right now, those big cap stocks that are bringing the excitement are Facebook, Google, and Amazon in particular. Those three. I think Google actually has earnings later today. I don't know what they'll do, but it doesn't really matter. Facebook is next week, and when all of them are done reporting, I think we'll see the markets fall either right after the Facebook earnings start to go down or after the election, one or the other. But if you can remember the past earnings seasons, reporting seasons we've seen in the stock market, Facebook is one of the last companies to report. And typically, people chase it. They try to buy it, play the earnings thing. But traders, they buy the rumors and sell the news. And after that, kind of excitement vanishes and the market has had pullbacks. So I think that's what we're going to face. However, you're mentioning people are predicting 70% losses or 50% losses or real dire situations. And I don't think that's going to happen this year. Instead, I'm more expecting some sort of dip. It may not even last but a week or two, down, let's say, to 2,000 on the S&P or something, or even 2050, 2050. It doesn't have to be a real massive drop, but just a weakness in the market, something like we saw during the Brexit situation. The worst case scenario would be something like we saw in January, where the market kind of fell for 2 weeks. But after that, I would think we'd get some sort of bounce into the end of the year. It may not be a strong or powerful one, but typically the market does always have some sort of end of the year rally. If you think back to last year, that's sort of what happened. We drifted in November and October. There was a top made and some weakness in December, and then a weak bounce, and the January drop hit. So I'm more thinking, to sum it up, a slight decline into Thanksgiving at some point, maybe starting next week after Facebook reports earnings, then a very short-lived bounce into the end of the year. But I think that will set the market up to have a more significant decline next year, possibly even a true bear market. But we'll have to see how things are looking then, so we can talk about specific levels and how things have unfolded.
We'll have more with Mike Swanson right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior. With a proven operator and finance team, GEM International trades on the TSX Venture Exchange. Symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're chatting with Mike Swanson. Mike, the London FTSE 100 index keeps setting new highs. What's the reason behind that?
Well, it's interesting because that Brexit event happened and people thought it would be a total disaster. But England is, as you point out, the stock market there is doing okay. Their currency, it's surviving. I don't know if there's a real specific reason except sort of a relief that the end didn't come out, and perhaps a lot of short covering as a result, because a lot of people did try to short English shares right after Brexit, but they've been having to cover their positions as things broke out and went higher. But usually when something runs up like that, you're going to see a pause at the very least. So I wouldn't be one to try to chase that at this point. In fact, I'm more interested in buying things when they dip and when they have corrections. And in that case, the gold and the mining stocks are really the most interesting buys right now. They started a new bull market this year. Of course, they did fall over 70% in their last bear market. The mining stocks fell 90%, in fact. And the thing about it is, when you get a very terrible bear market, and that one lasted for several years, typically the new bull market, when it happens, you see prices double off their bottom and just take off, and volume really come in, and all stocks in the sector go up, not just ones only in the exchange traded funds. And that's what happened with the mining stocks. Now, the thing about new bull markets, though, that start like that is once you get that first rally, you'll then see a pause period for 3 months to even up to 12 months. And that's where we are now in the mining stocks. We've seen pullbacks to the 200-day moving average for the HUI, the GDX, too. And it could very well be that they've put in bottoms. I'm really not sure quite yet. But even if they haven't, they've fallen enough where I don't think there'd be any more than 10% additional downside from their lows set early in October. But regardless, the important thing is with them, there's probably still more time to go for them to pace around and go sideways and build the consolidation zone to launch another huge rally. I think the next big rally actually probably won't really start till early next year, but it's something we've got to really keep our eye on. I own gold stocks. I'm going to keep my core positions. But some people want, to add on or really go big. I would wait a little bit before doing that. But the important thing is we've got to keep our eye on it, because in bull markets, when you get that second move that starts, it's usually not only does it go up more than that first move, which was enormous for gold stocks, but it goes up even for a longer amount of time. It can go up for several years even. And in the mining stock world, on the first moves, it's usually the big caps, the Newmonts, the Barricks, that lead on that first rally, which is what we exactly saw this year. But on that second move, in the mining world, typically see exploration stocks, junior stocks, the small cap stocks really start to break out and take off and go up enormously. You can see stocks that are a nickel go to 50 cents or even $1 over a couple of years. So there's actually, I think we're situated at a time where we're doing the interview where it doesn't seem like much is happening in the financial markets, period. A lot of people are falling asleep, but that always sets the stage up for moves that surprise people and opportunities that really can make people a lot of money. And I think the surprises when it comes to the stock market will be drops, but when it comes to gold and junior mining stocks, it'll be a rally probably starting next year that would really make a lot of people a lot of money. It would be some of the most exciting times to be involved in those precious metals markets.
Plus, I would think any junior miner that has survived the doldrums of the last 5 years will probably be very efficient and very profitable.
That's exactly true. In fact, one thing that happened to the sector is the stocks in the sector, because of the bear market, they just got totally creamed. But most of the ones that survived actually made bottoms a year ago, about in July, actually 2015. Even though gold went a little bit lower and the GDX HUI made minor lows in January, most of the juniors that are still around now, they actually bottomed that summer. Some of them, though, did vanish during that bear market. They just went out of business. So because an exploration property, most of them don't generate profits. It costs money to drill and look for gold. Some of the mines are high-cost mines that had to be shut down and so forth. So the subpar companies pretty much went under, and what you had remaining as we came into this year were the survivors, the best of the best. And now we're starting to see them raise money this year, and some new projects are coming online slowly. But I did hear stories and see, on the press wires, monitoring what's going on, that there were new developments, new things being done, and that wasn't the case a year ago. Now, a little bit of this is slowing down, but I think that next year we're going to see a real pickup, and we have management teams in the right mining stocks that are really positioned to take advantage of the next big rally when it does come and play out. I first bought gold stocks in 2002, but what was interesting about that time period was gold and the mining stocks actually had bottomed in 2000, and I got involved in 2002, and it wasn't really until that 2002 period that the juniors during that cycle of the 2000 decade, the first decade of our century, it wasn't until 2 years after the bottom in gold that the juniors really started to take off. Now, things aren't going to take that long, but the point is, there's a time delay. In 2008, there was a bottom then in gold stocks, but the market for the juniors didn't really heat up until, that summer of 2009. And it really wasn't until 2010 that, real activity started to come in. So, of course, that turn was really fast. It wasn't really driven by depressed prices in gold that played out for a long time, unlike this past bear market cycle was.
Now we know some gold bugs are saying if the market crashes, gold could hit $5,000, $10,000 an ounce. Are you among that crowd?
Well, when people nowadays, most of the general public, when they think of a market crash, they think of 2008. And in 2008, of course, gold stocks fell with the stock market. But in 1929, the gold stocks just pulled back on the initial crash with the market. They didn't, really collapse or anything, but they did pull back. And then after that, they went straight up for years, even though the stock market basically went straight down for 3 years. So it's hard to really, predict way ahead of time what could happen if, there's a stock market crash. Really, I'd want to monitor what is going on with the mining stocks in various sectors of the market as you go into such an event to try to get a feel for, what are they going to do. In the summer of 2008, the mining stocks actually broke down in August significantly. They broke a key support level in August of 2008 and started to fall really hard ahead of the stock market collapse, which happened and started in late September, really happened in October. So the mining stocks already had fallen to pieces. Now, I think a better comparison to what could happen today is the fall of 2000, because back then, the mining stocks, they made a bottom in the spring just as the stock market topped out, the NASDAQ topped out, but they then made a new low and continued lower into the fall. At the same time, the stock market was dropping, but the gold stocks bottomed out and just broke away from the market action. It just took off and continued to do, kind of went in their own world for the next couple of years, and even the stock market continued down to like 2003. I think that's more the case. There might be some short-term turbulence in gold stocks. I just think they're going to break away from the stock market. In fact, they sort of already have done that this year. They're not really trading in sync with the market averages. In the end, I think it's not so much the stock market that's going to be the key financial market when it comes to gold stocks, but the bond market and the U.S. dollar. And I think they're not at that point now, but in the next couple of years, I think, they can go into bear markets, especially the bond market, and that's what would drive gold up to the $5,000 or $10,000 level. And it would also be very bearish for the stock market. So it would be a bear market for different reasons than what we saw in 2008 or even 2000, and one beneficial to the mining stocks. But that's my kind of guessing of what's going to happen. And I could, we all kind of have models in our minds of what we think could happen. But in the end, I look at the charts to see what is actually happening, because with the charts, you can kind of project out 6 months ahead of time. So, in our conversation here, I'm saying we're going sideways with the mining stocks within a bull market. And in that situation, you accumulate if you own nothing. And if you really want to make a big trade, you just be a little patient and let the sideways action play out. And with the stock market, we're just in a dead market right now, which looks like the end of the bull market, like it's dying out with a whimper. So, they always keep the big picture in mind. And with those two big pictures, there's no reason to fear a gold stocks crash, getting caught up with the stock market.
Mike, thank you so much for chatting with us.
Thank you. It's great to talk with you.
My guest has been Mike Swanson, editor of WallStreetWindow.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.